Starting with you, Fred, is it rates alone that is sparking markets at the moment? It feels like rates have pulled back from their peaks.
Yeah, but people kind of don't pay attention to the day-to-day. We've gone from about 3 3/8 on a 30-year fix generically to about 4 3/4. And once it got into 4, people haven't seen these numbers of 4s and 5s and 6s in, I don't know, 15 years. So it freaks everybody out. But I think on top of that, you have the whole global financial picture that is upsetting people. Tariffs, Brexit, trade, the special counsel, but also the price of housing has freaked everybody out. It's like, wait a second, I'm not going to pay that much for this property. It's getting a little ridiculous. Oh, and interest rates went up too? I'm on the sideline.
Jack, how would you characterize why home builders aren't getting a boost here from the lower mortgage rates and interest rates we've seen in the market?
Yeah, I think the combination, anytime you see price increases in what we've seen over the past year and a move in rates, it's going to create a pause in the market. We are picking up some incremental sentiment concerns in our checks with realtors over the last several weeks, more so than rates. As you know, rates have come in about 30 basis points. But we think that some of the concern in the equities is a bit overdone. The market is normalizing some. That means that in some regions you're going to have more demand than in others, certain price points. And I would say where you're seeing it, you mentioned Toll earlier, you're seeing it in the more discretionary buyer, those that maybe would have thought about trading up at a time when prices were lower and rates were lower. What we're not seeing a real slowdown is in the entry level, and those are life events that are driving that demand, and that demand should only continue to increase over the coming years. And so it's really becoming a tale of several different markets where we are today.
Jack, what's your point in terms of where we expect rates globally next year? ECB comments yesterday suggesting the rate part of the bargain, maybe not the bond buying part, but the rate part of the bargain, unlikely to rise anytime soon.
Well, we don't have official rate forecasts. We're not economists, although covering housing, you sort of have to pretend to be one. We think existing market is probably flat year over year. We think new home sales are probably up about 1% year over year, because remember, new sales are filling some of that supply-demand imbalance. We still are in a pretty material supply-demand imbalance through the housing ecosystem. So, generally, I would not expect a move. As the Fed tightens, I think we see more flattening. I don't think mortgage rates, into the 5.5% range permanently affect the demand. And when you talk to some of the builders and you talk to the mortgage companies, we're not seeing a couple telltale signs that affordability is really impacted, meaning it's more sentiment. You're not seeing ARM loans. You're still seeing an overwhelming demand for 30-year fixed rate loans. And you're not seeing people really buy smaller houses yet. Now the builders, the public builders, all have really moved to smaller homes and cheaper priced homes at a varying degree, all the way back to maybe 2015. So it's really where you're positioned in the market and who the buyer is. But I don't think, we've done work, and I think what people forget is rents have gone up a lot too. So when you're looking at that payment, you've got some I think some resiliency into the mid-5s after that psychological pause that I think we're in the middle of right now.